So with that, let's welcome in exclusively Jeffrey Gundlach. He's the CEO and CIO and founder of DoubleLine Capital. Jeffrey, welcome back. It's good to have you as always.
Yeah, good to be back on Fed Day, Scott.
Yep. Your reaction to what you just heard?
Well, you kind of stole it a little bit. I said, usually in these post-Fed press conference appearances, I have a kind of a word of the press conference, and the word of this press conference is could. He said it several times, we could cut rates in September. So he also reiterated a number of times that they have a long amount of ammunition, a large amount of ammunition, if the economy does start to weaken. But what is interesting about, I think, the messaging from Chair Powell is he said that conditions in the labor market and in the economy broadly are sort of like they were pre-pandemic, on the doorstep of the pandemic. And yet the Fed funds rate is 525 basis points higher than that. Okay, I'll acknowledge the inflation rate is probably about 1% higher than it was prior to the pandemic, but that kind of means that there's a lot of room for them to cut short-term interest rates. Our inflation model suggests that based upon where the commodity prices are and what we expect from shelter to happen, that we could get a two-handle on the CPI. We already have it on the PCE, but we could have a two-handle. We could settle in even in the low twos. And if you have a positive real interest rate that's even 1.5%, that would suggest you have 150 basis points of room to cut rates without even thinking that you're being excessive about it. So I really think that we should expect to see the markets enjoy what the Fed said here, because they said not only could we cut rates at the very next meeting, but we could cut them a lot if we need to. And I think that's very heartening, particularly for the stocks that kind of got beat up, the high beta stuff, where interest rates cuts would probably be awfully helpful.
He mentioned numerous times, in fact, to your point, that the Fed is still restrictive. Should they have cut today?
I think they should have cut today, quite frankly. But, what difference does it make? 6 or 8 weeks or whatever it is, 7 weeks. I think the one thing that I find was funny when people asked about the political climate and saying, they don't want to be political, and September 18th is less than 2 months away from the election. I just think that's so laughable that if you cut rates 25 basis points, that would have any impact on presidential politics. I think if you ask the average American what the Fed funds rate is, they wouldn't even know that it's a number. They wouldn't even know what it means, let alone to know that it's at 5 3/8 today. So I just don't really think that that's very relevant. But I think this is a pretty reassuring press conference for the markets. I thought Jay was very well prepared. He even seemed to over-prepared. I thought he was reading more of his remarks, and particularly in the answers to questions, he seemed to go to a script. But that's okay. He had a thread the needle, I guess he really had to do, because it's clear that the employment data is getting worse. That's pretty obvious. I mean, the quits rate is going way down. The unemployment rate is now 7/10 off its lows. It's being artificially suppressed by government hiring, which has been in an interesting uptrend over the past 18 months or so. So I think it's clearly weakening. We see continuing claims on the rise. Initial claims are in an uptrend. So I think he wants to reassure people that he's watching these things. He's hopeful that the unemployment rate doesn't go up by 0.2 or 0.3 one of these months, but it has been rising. So we do have 2 more employment reports before the next Fed meeting, and we have 2 more CPI reports. So I think those are going to very strongly inform the rhetoric that we get and whether or not we get a cut of 25 basis points. He seemed pretty clear that they're not really considering at all, based upon the mix of the economy and inflation right now, cutting rates 50. I think that would be, you'd have to see the unemployment rate go up to probably 4.3, 4.4, maybe even 4.5 over the next 2 months, which seems unlikely for them to consider a 50 basis point cut in September. But there's cuts coming. The yield curve has been de-inverting. We're hanging out at about, 15 to 20, depends what minute you look at it. Basis points, higher yield on the 2-year than the 10-year. That was out at almost 110 basis points. several months ago. So it's been a big narrowing, but it's still inverted. And we still believe that there's a very safe place to be is in the 2-year, the 3-year, the 5-year Treasury, which should have pretty big rallies when the Fed, should they even cut one time, I think we de-invert the curve and head to a steeper yield curve. The long end of the curve, I feel, is still in the throes of angst or these interest rates and the level of the debt and the level of the deficit. I know I talk about this all the time, but it's extremely important in our world today. And I think the yield curve will steepen quite a lot in the next recession.